Hey everybody, if you want to understand monetary policy and what the Fed is doing, the Fed's actions, this is the video for you. Just invest about 15 minutes of your time, watch the whole thing, and you will understand both monetary policy and the current Fed's actions so much better. So let's just get to it right here. So here at Econ Busters, the first thing to kind of understand is we have a metaphor, okay, for what the Fed is doing. It has to do with the brake pedal and the gas pedal, but it's not binary. It's not simply they're putting the foot on the brake or the gas. It's slightly more complex. When you think of the brake pedal, you got to understand there's two things they can be doing. They can either be pressing down more on the brake pedal or letting up on the brake pedal. But before I go into pressing down and letting up, let me just help you understand that if their foot is on the brake pedal, that means they have a restrictive stance towards the economy. That's right. Whether they're pressing down or letting up, they have a restrictive stance. They're restraining the growth of the economy, okay? They are being restrictive towards the growth of the economy. They are putting some restraints on it, making it so the economy grows at a slower rate. Again, if their foot's on the brake pedal, they're making it so the economy grows at a slower rate. Now, if they're pressing down on the brake pedal, then they're becoming more and more restrictive, more and more restraining. And if they're letting up on the brake pedal, they're becoming less restrictive, or they're restraining economic growth less. But again, one more time, if their foot's on the brake pedal, they have a restrictive stance towards the economy. On the gas pedal, the parallels, you could probably guess them, right? If they're pressing down on the gas pedal, they have, well, first of all, if their foot's on the gas pedal, they have a stimulative or accommodative stance towards the economy. They're stimulated. They're being accommodative towards economic growth. If they're pressing down on that gas pedal, they're helping the economy grow more. They're being more stimulative. If they're letting up on the gas pedal, they're helping the economy grow by less, but they're still helping the economy. They're still pushing gas into the engine. They're still being stimulative or accommodative, even if they're letting up on the gas pedal. Again, you're letting up on the gas pedal, gas is still going in the engine. They're still trying to fuel or stimulate economic growth, okay? And of course, their foot can be on neither pedal. But to understand this metaphor, you've got to understand two things, okay? That there is the neutral rate, that's an interest rate that we're going to be talking about here in a little bit, the neutral rate, or R star, one and the same thing. And then there is their current policy rate target, okay? So let's go over their current policy rate target, okay? The policy rate, first of all, is this interest rate in the real economy. It's an interest rate at which banks lend reserves to each other, okay? It's known as the federal funds rate. That is their policy rate. And the Fed targets that rate, okay? So you get that policy rate target. And they currently have a policy rate target, just to let you know what it is of the shooting of this video. It's 4.75 to 5.0, and that means the federal funds rate is going to be within that range because the Fed is very good at influencing this particular interest rate known as their policy rate, again, the federal funds rate, okay? So the Fed has a policy rate, it's known as the federal funds rate. It's a specific interest rate in the real economy that they target, and here's why they do it, in hopes that whatever they do to the federal funds rate will transmit out into other interest rates in the economy, okay? That if they lower the federal funds rate, other interest rates in the real economy will hopefully go down. Now, just to let you know, the Fed has more influence over short-term rates because the federal funds rate is a very short-term rate, okay? And so it does help them influence short-term rates pretty well. As you get interest rates that are longer term, okay, they have less impact over longer term interest rates. So let's say a 10-year treasury bond, they're gonna have a lot less influence over, or a 30-year mortgage, they're gonna have a lot less influence over. They still hope they have some influence over those longer term rates, but not as much. So again, they have a policy rate. It's an interest rate that they can influence, and they're very good at influencing it. And whatever they make that policy rate do, they're hoping it transmits to other interest rates in the economy. And again, they have a current policy rate target right now, 4.75 to 5%, okay? Somewhere in that range, and we can definitely kind of bank that the federal funds rate is going to be within that range. Now we've got the neutral rate. The neutral rate is kind of is an estimated rate, not kind of, it is an estimated rate, okay? It is the rate that they estimate, that they say, look, if we got our policy rate to equal the neutral rate, so if our policy rate ended up being the neutral rate, we would not have our foot on the gas pedal or the brake pedal. We would not be restrictive nor accommodative. We'd be neutral, right? Of course, neutral towards the economy, okay? Economists kind of say it this way. It's a long-term interest rate, and it says it's an interest rate that in the long long run will neither cause the inflation rate to tick up nor the unemployment rate to tick up, okay? So again, it's not going to be restrictive nor accommodative in the long run. It would be neutral towards the economy. Again, the neutral rate, nobody knows what it is. It's estimated. We forecast it. The Fed tries very hard to estimate or forecast the neutral rate. Now, the next thing to understand is the neutral rate is truly talked about in what we call real terms, real interest rate, okay? Now, understand we live in a nominal world, so all the interest rates we talk to each other are in nominal terms. So when I said 4.75 to 5% earlier, that was a nominal rate. Real rates subtract off the inflation rate, okay? So just to make this real right now, okay? We're going to say the federal funds rate is 4.75. Remember, that's the lower end of that target, right? But that's in nominal terms. The current inflation rate is 2.5%. So you take 4.75, you subtract off 2.5%, and you're left with 2.25, okay? So in real terms, their current policy rate, if it was at the lower end of their range, would be 2.25%. I know that was hard to follow, but again, their range is 4.75 to 5%. I'm just going to pick the lowest end of the range, 4.75, subtract off the inflation rate, which is 2.5%, and I get 2.25% in real terms. So that is their current policy rate in real terms. The forecasted neutral rate by the Fed, and by the way, it's not, I don't think the people on the FOMC, the Federal Open Market Committee, even all have the same neutral rate in their mind. But I would say that people on the FOMC kind of think of the neutral rate being somewhere between 0.5% and 1.5%. And so for the purposes of this video, we're going to say 1%. But again, the neutral rate is communicated in real terms, right? So if you add on the inflation rate, we would be neutral from a nominal standpoint. So I'm adding on the inflation rate of 2.5% to, again, the neutral rate, the forecasted neutral rate of 1%, and you get 3.5%. Hopefully that makes sense to you, okay? So that would be the federal funds rate in nominal terms being neutral. And again, if the Fed got their policy rate, their current policy rate, to be 3.5%, they would be being neutral towards the economy. Their foot wouldn't be on the brake or the gas. Now, if you're confused, stick with the video. I promise you're going to get clarity. Right now, okay, again, the neutral rate, I'm going to start talking in real terms again. The neutral rate is 1%, okay? Their current policy rate, at least if I take the low end of the range, is 2.25% in real terms. Again, if you add on that inflation rate of 2.5%, you get to that 4.75. But I don't want to do nominal, I want to do real. So this is their current policy rate in real terms. Their foot is on what? The brake pedal, okay? Now, if they were to increase this, okay, their foot would be pressing down more on the brake pedal, okay? They would be moving interest rates even higher, becoming more restrictive, okay? Currently, what the Fed is doing is we think they're going to be lowering it, okay? That's what they have basically told us, is they're going to be going through a series of lowering it, and I'll tell you why in just a little bit. So they're going to be lowering it. Remember, the neutral rate, we're saying for purposes of this video, is estimated by the Fed to be 1% in real terms. So a lot of people think that they're going to continue to lower it and continue to get towards 1%. Now, I want you to understand a little bit more vocabulary. What you might hear out there in the news is the Fed is normalizing, okay? Normalizing happens when either they're letting up on the brake or letting up on the gas. That's right. If they're letting up on the brake or letting up on the gas pedal, that means moving their current policy rate closer to neutral. That's what they're saying. They're normalizing, okay? And we think the Fed is normalizing right now. And now I want you to understand why that is, okay? Again, soup to nuts, okay? They have a dual mandate: price level stability, maximum employment. Dual mandate: price level stability, maximum employment, okay? Now, it was, if you just go back like a year ago, and really you could even say maybe just like 9 months ago, okay, but definitely a year ago, year and a half ago, 2 years ago, the Fed was very much worried about price level stability. The inflation rate got way above their inflationary target of 2%, okay? So this was a big issue. So they were really worried about this. Maybe we could say they were really worried about this, okay? And so they became much more restrictive. They were raising interest rates, okay? And they got it above the neutral rate, and they kept on raising interest rates. In fact, in nominal terms, they got to what we call a terminal rate, which is the highest that they raised the interest rate during that particular rate hiking cycle. They got it to 5 to 5.25%, okay? And that's because they were very much focused on price level stability. Now, I did this weird thing with the arrow. I kind of raised it up, okay? I'm trying to show you like what side of the mandate are they worried about. So they were like worried about price level stability, and even more worried, and it became that they were almost solely focused on price level stability. They weren't worried about this at all, and this was not a problem either when we were having that inflationary problems, okay? So they became very restrictive. Now, if you listen to what happened in the last Fed meeting, the Fed said we have recalibrated. The recalibration, I know a lot of words, normalization, recalibration. The recalibration was, hey, we're no longer so focused on price level stability. Hey, now we're getting back to a point that we're kind of right here in between the two. We see what we see as more symmetric chances of problems. And symmetric means either one of these sides, okay? It's like 50-50. This could become the problem, or this could become the problem, okay? They were asymmetric in their risk. That means that calibration, when you're asymmetric and you think price level stability is the way bigger risk than this one, okay, then they're focused right there. And again, they become very restrictive. But again, most recently, okay, their worries about inflation have come down significantly, and they've actually seen a little bit of weakening in the job market, though it's a very murky picture because the latest data there did not show very much weakness, okay? But overall, okay, if you look over the trend of the last 3 months, we've seen weakness here, and so they've recalibrated. That was the word that they used. They've recalibrated. They're saying, hey, where are we worried about? What are we worried about when it comes to our dual mandate? More price level stability or maximum employment? Hey, we really see symmetric risk, okay, balanced risk between the two, kind of 50% chance of this, 50% chance of that. Hey, that means we should be closer to neutral, and that's why about a month or so ago, the Fed did their decrease in interest rates, okay? They lowered their interest rate. Now, what they did is they just became less restrictive. Their foot is on the brake pedal from the Fed standpoint, the way the Fed sees the world, their foot is on the brake pedal and is still on the brake pedal, but they let up on the brake pedal, okay? Again, they came from 5, actually I was a little bit off there. It wasn't 5 to 5.25. Actually, their terminal rate was 5.25 to 5.5. So they went from that terminal rate from there down to 4.75 to 5%. They did what we call a half a percentage point cut, okay, a 50 basis point cut. Why? Because they're trying to normalize. Why are they trying to normalize? Because again, they recalibrated. They don't see their current risk as being so asymmetric. Hey, it's just inflation's our big risk. Now they've recalibrated. They see equal risk between their two mandates. So now what do we need to do? We need to normalize our rates. And again, the Fed is basically telling us, be prepared. We're going to continue to normalize, okay? To let up on that brake pedal. We're going to move towards the neutral rate because we've recalibrated. We see equal risk. If we see equal risk between the two, we're going to move towards that neutral rate. Now, if sometime we fall into a recession, right, and the unemployment rate starts ticking up, and of course we do not expect inflation to be too much of a problem. It could be, but generally when we see that unemployment rate start ticking up and we fall into a recession, inflation is not a problem. Price level stability doesn't become a problem, and they would recalibrate, right? And they would say, hey, this is our big worry. And their policy rate would no longer, I won't be able to erase it completely, but their policy rate would no longer be here. They would move their policy rate below the neutral rate. That's right. And by the way, they can get the neutral rate even below, in real terms, 0%, okay? There is a zero bound to the nominal interest rate, but not the real interest rate, okay? So they can move that policy rate, and even in real terms, well below 1%, okay? So they can move it way down here. So again, if they thought employment, asymmetric risk in the future because of a recession, employment became the worry, they would recalibrate and say, hey, this is now our issue. We're not so worried about that. Let's get our policy rate to be down here. And if they were moving this way, trying to lower and lower that real interest rate, they're becoming more and more stimulative. As they lower interest rates, more and more stimulative. And then at some point, if they feel like they've had the economy turn the corner and things are getting better again, they would recalibrate again. and they say, hey, that's not so much our worry anymore. And again, we would be moving back towards towards the neutral rate, letting back up on the gas pedal. Again, normalizing. Oh my gosh, so much terminology, right? We got the neutral rate, we got the current policy rate target, we've got normalizing, we've got recalibrating or recalibration. Anyhow, that's my bell. That means I've got to end this video. I hope that made sense to you. I hope that helps you understand monetary policy and really understand Fed actions. We'll see you next time here at Econ Busters. Thanks for tuning in.